Tell my very good evening to you all. Am I audible? Can you hear me? Okay, now I will start. We were discussing sources of capital and weighted average cost of capital. We initially discussed what are the alternative sources of capital available for a business organization. Thereafter, we started discussing how to compute weighted average cost of capital. Weighted average cost of capital mainly depends on, right, basically two main factors. There are some other indirect factors, right? Basically, mathematically, two main uh, factors. That is, cost of individual capital components. What is it? Cost of individual capital component and weight of each capital component in the capital structure. Right. If your capital wholly represent from equity capital, then your total capital represented by equity capital, then your cost of capital or weighted average cost of capital equal to cost of equity, because total capital is contributed only by the equity capital. So equity capital providers required rate is the company's cost of capital. But most of the organization nowadays, they use mix of capital. Basically, owners equity capital and debt capital. So if you have source funds from both owners equity and from external debt capital providers, your capital consists of two main components, debt capital and equity capital. The proportion between this debt capital and equity capital is what we call capital structure. Pradhana Vyuhaya. As far as the economy, right, national economy is concerned, we talk about economic structure, Rataka Arthika Vyuhaya. Economic structure shows how the agricultural sector, industrial sector, and service sector contributes to total economy. Similarly, capital structure shows how the debt capital and equity capital contributes to total capital. So accordingly, let's assume an entity's capital represents debt capital and equity capital. Let's assume debt capital is 75% and equity capital is 25%. That means relatively high debt capital. So you know capital stock is debt to equity. The capital stock is debt 75, equity 25. Or you can take whatever the combination. So that is your capital structure. Then for you to compute weighted average cost of capital, you know you need to find out this proportionate size of the capital, how much debt capital, how much equity capital as a percentage. That is your weight. Then you need to find out cost of each capital component. So we have two capital components, equity and debt. So we need to find out, right, what is the cost of debt capital. Then we need to find out what is the cost of equity capital, right? Because in a business scenario, in a case, or in a particular examination scenario, right? You are not given directly cost of debt capital. You are not given directly cost of equity capital. You are given relevant information related to debt capital and equity capital or data related to debt and equity. Using those information or data, you need to compute cost of debt capital. As far as cost of debt capital is concerned, we need to always consider after tax cost of debt because debt capital interest payments is tax deductible. So there's a tax saving advantage is there with the debt capital. So accordingly, we need to find out cost of debt. Then we need to find out cost of equity. So we were discussing last week. We discussed how to compute cost of debt capital. Let's say you have borrowed a bank loan and you are paying interest rate of 15%, right? If you have source funds from a bank loan, interest rate 15% now, right? It basically represents, approximately represent your cost of debt is 15%. But since there's a tax advantage, your after-tax cost of capital, which should be considered for cost of capital computation, after-tax cost of capital is equal interest rate times multiplied 1 minus t. So that is the bank loan related cost of capital. Take the interest rate multiplied by within bracket 1 minus t. Right. If you have source fund from by issuing debentures or corporate bonds, debentures or corporate bonds, let's assume, right, which are irredeemable. That means you have issued debenture certificates or the instrument and you have raised funds, you have collected funds from the capital providers. You are not going to repay it. Right? Debenture 1,000 rupee, you issue the debenture certificate and collect 1,000 rupee. You are not going to repay it at all. Irredeemable. You are not going to repay this 1,000. So accordingly, this kind of debt is considered as irredeemable debt. So if you have purchased by buying this certificate, you will be receiving, let's assume, annually interest rate. Let's assume this debenture instrument entitled for uh, 12% coupon rate on the face value 1,000 rupee, 12% coupon rate, 120 rupee. They will keep paying this interest annually. At the end of each year, you will receive this interest receipt at the end of each year. So from the investor's point of view, investor is going to receive 120 rupee for an indefinite period because irredeemable. End of each year till infinity. So cash flow is something is like what? Perpetuity. Constant cash flow continuously for an indefinite period, right? So we discuss how to compute this irredeemable debts costs. Take the market price. If these debentures are irredeemable, there's a market to sell. Let's say you are not going to live till infinity, right? You are not going to live as the investor. So whenever you want, you can sell your certificates to someone else. Let's say you purchase at the age of 30, you purchase a debenture, you hold it that debenture for 50 years. At the age of 80 years, after holding 50 years, right? Still you can't ask the money from the company. So what you can simply do, sell the certificate to someone else. So you have a market value, market price. So according how to compute the cost of irredeemable debt, cost of irredeemable debt, we discuss here coupon interest, right, times 1 minus t divided by market price, right? You can take coupon interest times 1 minus t divided by market price. So this gives you, right, the cost of equity. Coupon interest, right, it is 120 rupee. 120 rupee times 1 minus t divided by market price because if the debt is irredeemable, right, you have the opportunity to sell this instrument to someone else. Someone else. So according to that, the market tradable instrument. This is a tradable instrument. That's a market price. Take the coupon interest in rupees times 1 minus t divided by again market price in rupees. Udah තියෙන rupee value එකක් කියලා තියෙන rupee value එකක්. උඩ coupon interest in rupees times 1 minus t divided by market price. So accordingly, if the debt capital is irredeemable, it is very easy to compute cost of debt capital. Then what if debenture or bond is redeemable? Redeemable means company issue today this debenture instrument for 1,000 rupee. Company promised to repay this debenture or settle or this debenture after 5 years from now. So debenture is for 5 years. End of the 5 year. So 5 year we call a maturity period is 5 years. At the maturity date, after 5 years from now, company will collect your instrument. Company will collect the certificates from you and repay the money back to you. So according from the investor's point of view, today you buy the instrument, paying the money to the company. I think you are an investor. Today you buy the certificate as an investment. You buy the certificate and give the money to the company. It is your investment. Like in a business project, that is the initial cash outflow. Initial cash outflow is your amount you lend the company. So that is an outflow. Initial outflow is your investment. In return, what you are going to earn in the future. End of each year, you will receive coupon interest cash flow. If it is 12% interest rate, coupon rate, for 1,000 rupees, 12% is 120. 120 each you will receive for next 5 years if the maturity period is 5 years. Next 10 years if the maturity period is 10 years. So 120, 120, 120 each for the next 5 years or 8 years or 10 years. That is the maturity period. So during the maturity period, you receive constant interest income for the maturity period. So that is constant for 10 years. Constant cash flow, continuous cash flow for 10 years, 5 years. What is it? It's something like annuity. Constant continuous cash flow for a definite period. Annuity. So you, right, initially you invest 1,000, in return you receive 120 each. But don't forget me, end of the maturity period, you receive your money back, right? At maturity, company will repay the amount. So that is also considered as a cash inflow. Sometimes company may redeem, sometimes issuing company may redeem this particular debenture certificate at its par value. Par value කියලා කියන්නේ face value. By the time they issued at 1,000 rupee, collected 1,000 rupee, and they invest in their real invest in their business. After 10 years, at maturity, they will collect the certificate from you and cancel it and give the money back. Sometimes they might repay you 1,000 rupee. In general, 1,000 rupee they might give. So accordingly, let's assume they promise to pay, settle or redeem at par value. එහෙමනම් 120 each for 10 years interest given or end of the 10th year, they will give you 1,000 rupee back. So this 1,000 rupee should be considered as a cash inflow. So accordingly, how to compute the cost of debt capital in a scenario like this? For redeemable debentures or debt capital like this, it is very important. Cost of debt capital is simply the IRR of that investment cash flow. So consider that particular cash flow scenario as an investment project or just a simple project, investment project. So compute IRR because we have initial cash outflow 1,120 each for 10 years, right? Annuity nature cash inflow at the same time, end of 10th year, another big lump sum amount received is the the maturity value. So by considering this initial cash outflow and future cash inflows, compute IRR. So project IRR is your cost of debt capital. So for you to compute IRR, there are different approaches. IRR simply technical meanings. What is the technical meaning? IRR is the discount rate where NPV becomes zero. Company investment project එකේ NPV zero කරවන discount rate එක තමයි IRR කියන්නේ. Right? So simply IRR means the project yield, investment yield. Right? There are three approaches to compute IRR. I explained, right, all the three approaches. First one, trial and error method. You just try different discount rate. You can start as a guiding principle. You may start with the coupon rate. Coupon rate එකම discount කරලා බලන්න and see whether it becomes zero. If it is not become zero, right, depending on the answer you got, you may decide to increase the discount rate or decrease and try a different discount rate and try this till your discount NPV becomes zero. It is called trial and error method. But we don't recommend that method because it wastes your time. Right? Other method is more practical method is using this formula. IRR rate is equal lower discount rate plus lower discount separately write down, right? Keep aside and compute two IR, two NPVs. එනවල කැමති rate දෙකක් පාවිච්චි කළා. right? කැමති discount rate දෙකක් පාවිච්චි කරලා NPV දෙකක් හොයාගන්න ඕන. You have to compute two NPVs. right? දැන් කොහොමද first discount rate එක පාවිච්චි කරන්නේ? මොන හරි කමන් rate එකක් ඒ scenario එකේ තියෙන. It may be coupon rate. Coupon rate එක පාවිච්චි කරලා project එක discount කරන්න. Compute to NPV and see whether NPV is positive. If NPV is positive, you better increase the discount rate. ඒටදී ටිකක් වැඩි ලොකු discount rate එකකට ආපහු project එක discount කරලා find out another NPV. It is ideal if you generate a negative NPV. එතකොට NPV දෙකක් තියෙනවා. Ideally එක NPV එකක් positive, other NPV is negative. Then you are ready to compute your uh, IRR. This is the formula. Lower discount rate separately keep aside plus this answer. What is the answer? Take the NPV1. NPV1 is the NPV at lower discount rate. Low NPV දෙකක් පාවිච්චි කරන්නේ ඒ දෙකෙන් අඩු මෙන්න මේ මුලින් දැම්ම LDR එකට අනුව NPV එක divided by ඒ NPV එකයි higher discount rate එකේ NPV එක අතර difference distance එක. මෙයා negative වුණාම negative minus negative වුණාම ඒ figure එක plus වෙනවා. right? ඒතර ඒ දෙකේ gap එක අපි ගන්න. ඒ fraction එකෙන් වැඩි කරන්න discount rate දෙකේ difference එක. higher discount rate එකයි lower discount එක මෙතන delta discount rate. Let's say you apply 12% and 25, 12% and 20%. And a delta discount rate is 8%. Right? So accordingly, for redeemable debt, cost of debt capital is represented by IRR. Right? Okay. So this is what we discussed last week. So today we'll discuss so meeting my third approach graphical illustration of computing discount maybe IRR, trial and error method. Second one, formula approach. Third one, right? You have two discount rate and two NPVs. Discount rate දෙක යටතේ NPVs දෙක graph එක මෙම plot කරලා line එක අනින්න. NPV positive තියෙනවා, NPV negative තියෙනවා. මේ පැත්තෙන් y-axis represent NPV. You have positive NPVs and negative NPVs. X-axis represents discount rate you use. At 5% discount rate, let's assume you got positive NPV because lower discount rate, higher NPV. Most of the cases for ordinary type of business, right? Generally, for conventional ordinary types of projects, lower discount rate NPV value. When we increase discount rate, present value අඩු වෙන නිසා මොකද වෙන්නේ? NPV minus යනවා. Right? So accordingly, at lower discount rate, you have positive NPV. At very high discount rate, you have negative NPV. So, and the x-axis represent discount rate. So accordingly, there, right, this graphs, this particular line intercepts your x-axis, which represent discount rate. Right, the point at which this line intercepts this x-axis, you can see what is the NPV. NPV becomes 0. මේ line එක දිගට NPV 0. What is the definition of IRR? IRR, the technical definition is what? IRR is the discount rate at which NPV becomes 0. So, right, so this is the point. Right? Now, may point එකේදී පැහැදිලි NPV 0 discount rate එක මෙතන. එහෙනම් මෙන්න මේක තමයි IRR කියන්නේ this is our cost of debt capital. Any right? Any other discount rate? Let's say if you take 10% discount rate, at 10% discount rate, you can see NPV is minus, not 0. At let's say 6% discount rate, somewhere here, NPV is positive. As and when you increase your NPV, when you increase your discount rate, NPV getting reduced at a particular NPV discount rate, it becomes 0. So at this point, you can find out what is the discount rate is between 5% and 10%. So discount rate approximately seems like 8% or 7%. It seems like 8%, right? So this is your IRR. So according to my, you know, three ways of computing IRR: trial and error method, formula approach, and graphical approach, right? Okay. So so this is what we discussed last week. I just again explain them to refresh your understanding. We will now discuss cost of equity capital, right? Cost of equity capital. So this is very important. How to compute cost of equity capital? I mean, there are different approaches to compute cost of equity. Right. First method is right using zero growth model. Right, using zero growth model, or if you want, you can say using zero dividend. Right here, the zero growth model means zero dividend growth model. We don't need to say specifically dividend, but this zero growth relates to the dividend, right? Dividend is not subject to growth, right? So accordingly, we will see as an approach. I want to give you a simple activity to understand. So what is this formula? I want to convince you how this formula is originated, right? Using the time value of money. I have the full authority to give you any kind of time value scenario because, right, I equipped almost all the techniques, very important techniques we discussed. So accordingly, before talking about cost of equity, uh, let me to give you a simple activity, right? Right, ළමයි මේ let's assume, right, there's a company, let's say Alpha PLC pays annual constant dividend of rupees 6 each. It is expected this dividend